Let's start with a hard truth. In 2024, the S&P 500 went up by about 25%. That is a fantastic return for 1 year. But the average investor only made 16.5%. They left an incredible 8.48% on the table. This isn't a small mistake. This is the difference between a good year and a life-changing one. This happens year after year. It adds up to a fortune lost. Not because the market is impossible, but because of simple, fixable mistakes almost everyone makes when they start. The problem is not that you are unlucky. It is not that the market is rigged against you. 62% of investors think it is. The real issue, most people fall into the same traps over and over. They buy high because everyone else is buying. They sell low because they get scared. They have no real plan. They react to the news and their emotions. The single biggest mistake I see is investing with no plan. This is like trying to build a house without a blueprint. You just buy a few stocks you heard about on the news. You buy some crypto because a friend told you it was going to the moon. There is no logic. There is no system. Every decision is random. You have no idea why you are buying something, when you should sell it, or how it fits into your overall financial goals. This is not investing. This is gambling, and the odds are not in your favor. Think about it this way. A study of over 66,000 investors found that the most active traders, the ones buying and selling all the time without a clear strategy, underperformed the market by 6.5% every single year. They were busy. They were making lots of moves. But all that activity just led to worse results. The next major trap is chasing what is already popular. We have all felt it. A stock shoots up 300% in a month. Everyone is talking about it. News headlines are celebrating it. You feel like you are missing out, so you jump in and buy it near the top. This is called chasing performance, a classic mistake. It's driven by the fear of missing out, or FOMO. One study showed 68% of crypto choices were based on FOMO. By the time a stock is hot and all over the news, the big gains have likely already been made. Professionals bought it months or years earlier when it was cheap and unknown. Retail investors often pile in at the peak right before the price corrects or crashes. This is how people buy high and sell low. Humans are emotional creatures. Emotions are your worst enemy when it comes to investing. Two feelings cause the most damage. Fear, greed. Fear makes you panic sell when the market drops. You see your account value going down, you get scared, and you sell everything to stop the bleeding. Greed, or FOMO, does the opposite. It makes you buy overpriced assets at the peak of a bubble because you cannot stand to miss out. Both are gut reactions that almost always lead to bad decisions. The data on this is crystal clear. One of the main reasons the average investor underperforms, they sell during downturns and miss the best recovery days. According to Dalbar, this cycle of selling low and buying high drives the performance gap we see every year. The market drops, investors panic and sell. They sit on the sidelines in cash while the market rebounds. They only feel safe enough to get back in after prices are high, locking in losses. Automate your investing. Set up an automatic transfer from your bank to your investment account every single month, every single payday. This strategy is called dollar cost averaging. You invest the same amount on a regular schedule regardless of market direction. You buy more shares when prices are low. You buy fewer shares when prices are high. This automated system takes feelings out of the equation. You are no longer deciding when to invest. The decision is already made. The transfer happens automatically. This prevents you from trying to time the market. Most investors fail at that. Put your plan on autopilot to commit to a long-term strategy. Protect yourself from your worst instincts. It's the most effective way to stay disciplined when fear and greed scream at you to do the wrong thing. Many new investors think that to get big returns, they need to take huge risks. They get into day trading, use leverage, put all their money into one or two speculative bets. The statistics on these high-risk strategies are terrifying. For example, 80% of day traders quit within the first 2 years. Why? Because most of them lose money. One study found that only 3% of day traders were consistently profitable. Using leverage or borrowed money makes this even worse. When you use leverage, your gains are magnified, but so are your losses. It is a double-edged sword that cuts deeply. Data shows day traders who use margin for leverage have an average return of negative 4.53%. They are not just underperforming the market, they are actively losing money. They are trying to get rich quick, but instead, they are going broke even quicker. The solution here is simple but crucial. Practice proper risk management. First, never invest more than you can afford to lose, especially in risky assets. Second, use position sizing. Limit how much of your total portfolio goes into a single investment. A common rule is to not put more than 5% of your money into any one stock. If that one stock goes to zero, you've only lost 5% of your portfolio. Third, and most importantly, stay away from leverage. As a regular investor, you do not need to use borrowed money to build wealth. The stock market has historically returned around 10% per year on average. That is a fantastic return that will build significant wealth over time through the power of compounding. There is no need to take on the catastrophic risk of leverage when a patient, steady approach will get you to your financial goals safely. Slow and steady really does win the race. Investors lose because they have no plan. They chase hot stocks. They let fear and greed drive their decisions. They take on too much risk, and they are not patient. The data is overwhelming. These behaviors consistently lead to underperformance. In 2024 alone, the average investor missed out on an extra 8.48% in returns. But it does not have to be this way for you. You can fix this. The solutions are not complex. First, create a simple, written investment plan. Second, stop chasing yesterday's winners and focus on diversification with index funds. Third, automate your investments to remove emotion from the process. Fourth, manage your risk by using position sizing and avoiding leverage completely. And finally, be patient and let your disciplined strategy work for you over the long term. These 5 fixes are the foundation of successful investing. Building wealth is not about finding secret stocks or timing the market perfectly. It is about having a system and sticking to it. It is about discipline, patience, consistency. By avoiding these common traps, you shift the odds dramatically in your favor. You stop gambling and start investing.